Welcome to the daily update for Thursday, June 4th, 2015. We will look at the action in the market today and then see how things look for Friday, June 5th. Interesting day finally. We finally had some action in the market. The S&P broke the 2100 level to the downside today, and it put up a good fight, and this is pretty significant support. Now, are we going to bounce up out of that? We have a lot of things going on. The market hasn't broken down completely, but what I've done on the oscillators, I have changed all time frames to down right now. Now that could change if we start to show some improvement on Friday. But all of our oscillators after today's action, and some that I won't even be showing today, uh, everything that I look at that's based on an oscillator, okay, not a moving average. Our moving averages are still doing okay, and we want a total confirmation of both the moving averages and the oscillators. We want both of them to confirm each other for a major change in trend. So moving averages were fine, oscillators were down, and that's more intermediate term, but some of our long-term oscillators are crossing over based on the weekly charts, and then last weekend in the video when I did the monthly charts, some of those are crossing over negative. So once we broke below 2100 today, Growth Concepts is now taking the position on an oscillator basis that we're in a downtrend in all three time frames, but we're still in an uptrend on all three time frames based on our moving averages. So we're getting some conflict there. Okay, so the S&P did have a down day today, not a monstrous down day, but at the same time, it was a critical down day because we broke through that 2100 level, which is the 50-period moving average. And that had been tested 3 times before we broke through it. It was last week, earlier this week, and then today. And then it took a couple of tries even today before we eventually broke through it. That's pretty significant. There's been no change really in the Greece situation. They're supposed to come up with a payment tomorrow. And basically what has happened is their creditors are asking for money, the IMF, the International Monetary Fund, and then Greece says, we're not really going to give you any money. So the Prime Minister of Greece, and I don't know how to pronounce that, is that Tsipras? Do you pronounce the T? I haven't I haven't been watching any newscasts to catch how the people in the news are pronouncing this. So words that start with 2 consonants are weird, especially when the first one's a T and the second one's an S. So Tsipras, okay, the Greek Prime Minister, all right, expected to address the Greek Parliament Friday evening, which is going to be Friday during the day our time. So you can probably look at CNBC, the Fox Business Channel, Bloomberg, and so forth. They're probably going to cut away and be showing this speech to the Greek Parliament in real time, even though we're not going to understand anything that they're saying. So they're probably going to have some kind of translation going on in the meantime. But that's kind of the headline, the pop news right now. And it's a critical thing. I don't mean to dismiss it. It's just what a lot of the financial folks right now are choosing to fixate on. But it is a big deal. I mean, this is a country that's in trouble financially, and what's going to be done about it. But I would also expect to see more countries down the road. Ireland's not too far behind. Spain's not too far behind. The United States is not too far behind as far as financially what's happening. It's this socialist form of government that's starting to implode on itself. It can only last for so long. And we're trying to implement that here in the United States. And yeah, the party's going to go on for a while, but then there's going to be a lot of trouble. Remember, Europe tends to precede the United States, where Asia, meaning Japan, the Philippines, and so forth, tends to follow. And Taiwan, Korea, okay, they tend to follow the United States in culture, in fashion, in music, and financially as well. So if you want to look at where the United States is going to be 8, 10, 15 years from now, look at what's happening to Europe right now. And that's where we're going to be. Because they kicked into this socialist mode before we did. Even though ever since I can remember, there have been socialist elements in the United States government pretty much ever since Teddy Roosevelt, when we decided to nationalize the parks, the national parks. And then Franklin Roosevelt, with his New Deal back in the 30s, welfare, Social Security, things like that. Actually, not welfare. That was in the 60s under Johnson. The Great Society. These are all government programs that are out there to benefit people that were supposed to be short term. Well, once you get a government program going, you really never get rid of it. So it just kind of builds on itself. Well, that's what we're seeing in the United States, but that's already what's been happening over in the EU, and they're wondering why things are falling apart. So, anyway, we'll expect to see what happens with the Greece situation on Friday during the day our time, which would be Friday evening their time, and we'll see what this prime minister, whose name I can't pronounce, what he has to say. But the IMF came out with a separate report today saying that they're cutting the GDP estimates for the U.S. from their original stance of 2.5% growth for the year, which is not really good, but it's certainly not inflationary. You want a good 5 to 6, 7, maybe even 8% growth every year in a good, healthy environment. 2.5, yeah, we're growing, but not very much. In fact, our last GDP report was down. So there's even some recessionary fears. Is recessionary even a word? That are out there right now. But the market really didn't pay much attention to that. It's the Fed that the U.S. market really acknowledges and pays attention to. So you would think that the bonds would really like this because they like a weaker economy. And then with bonds reacting, well, we're the last few days we've seen a decoupling. With the bonds were up slightly today, where the stocks were down. Where yesterday the bonds were up, or bonds were down and stocks were up. But they cut it. I'm sorry, I misread this. They cut it from 3.1%, their stance, to 2.5%, and they're urging the Fed within, buried deep in their little statement there. They're urging the Fed to delay raising interest rates. On a good day with this would have sent the market through the roof. But because of the Greece situation, because technically we're looking at a lot of warning signs that seem to now be coming into play that I talked about in the newsletter last weekend and the weekend before, and I've been talking about every day in all of the videos, we're seeing some weakness start to really develop in the markets, and I'll go through some of that today. All 10 sectors were down today. Again, I'm thinking possibly now of changing it back to 9 sectors. As I look at the telecom sector, it's not as liquid as I like it to be. With the ETFs and the options and so forth, I may end up dropping that back down to 9. Well, give me the weekend. Well, I may not have enough time. Give me some time before I decide if we drop back to 9 sectors for the S&P. And then I saw another one that even included real estate as one of the sectors. So I'll play around with this and see what we go with. Bonds did have an update, and I have the total bond chart that I'll bring up here in a little while. And this is another interesting story. Volume was above average. We're still seeing any intensity, any enthusiasm, any gusto in the market when it's going down. We see an increase in volume. We see an increase in intensity. And in fact, on the intraday chart here, you can see these are the daily volume, or every 10 minutes. This is the 10-minute chart right here. We gapped lower. Okay, the futures were quite a bit weaker, and we had a gap lower open. We immediately tried to bounce right out of that. We went right back up to the opening level, and then we jetted off to the downside, and we came right down to 2100, right around this area. We floundered around here for quite a period of time, a good hour and a half or so, and then finally, right as the lunch hour ended back east, right about 1 o'clock Eastern time, which is 10 a.m. Pacific time, we saw a breakdown, and a whole lot of stop loss orders were triggered right here, and we saw this move to the downside on increased volume right here. So today was significant. Not that we fell 18 points. That's only 0.86%. That's less than 1%. But what was significant is that we broke through what had been tested support. We tested it on Tuesday, and then it's off the chart now, but we tested it last week. So this was pretty significant short-term support, and then we saw a real increase in volume as we broke through it. We didn't really get all that intense to the downside. The market, I think, kind of cooled down a little bit, and here's the closing bar that we had. until the report comes out tomorrow, because we have the employment report coming out. That's probably the most important economic report of the month, and it's due out at 5:30 a.m. Pacific time. So we'll be watching that and see how bonds react, and then an hour later see how stocks react. Could be positive. Who knows? What they're saying in Greece might make the market. We're down here. All hope is not lost, but on a trend oscillator basis, we have switched negative, and so yes, I would be more inclined to be negative right now than positive. But we have to just kind of see how things play out. The S levels for tomorrow were already set, as well as the pivot level for tomorrow. It's right at 2100 now. So if we do jet off to the upside, we're going to now, what was support now turns into resistance at 2100. So if we start coming back up, we're going to have a hard time getting through this again. Perhaps. Usually that's what happens. So if we start jetting to the downside, we're going to look at 2088. That's a pretty significant move down. And then we have S2 down at 2080 right now. So the market has more room to fall if that's where it's going to go as we get out of this upper end of the trading range right now. Here's the 30-minute chart, which just shows the gap lower and then the move lower right below, and then how we broke below 2100. And then we built a pretty good base down here at the 2095 area for right now, which was S1 based on this chart right here. This is where we found support. A lot of people trade based on the 30-minute, 60-minute charts. And you remember from previous videos, these daily pivots are calculated, R2, R1, P, S1, S2. They're calculated based on the previous day. The 30-minute chart is calculated based on the previous week. So that's why you have different levels, and that's why we settled down in this area today. And that's why we have to look at different time frames all at the same time, because like, why does a stock go up and stop at that point? Why does a stock go down and stop at that point? Well, with the S&P giving out so much information, with millions of people watching all of this, they're noticing these areas too, and so gives us a chance to react. Okay, you may have gone short as we broke through 2100, but now we're camped right along this line. Maybe you have some buy orders down here, or possibly up here. Or, I'm sorry, let me rephrase that. Maybe you have some more sell orders down here and some more buy orders to get out up here. So then looking at this 30-minute area, then we can see that there's a pretty big support level established. Then here's the 60-minute chart. We also see that same support level being established here, but really on an hourly basis, this was a down day overall. You can see this bar right where I have the cursor right now, it was the opening bar, and we just spent the day going down and then camped out sideways near the end. So be looking at this 2095 level as pretty significant right now. But if we do try to go higher, we might see, in fact, we're probably going to see some pretty good overhead resistance right here. If we gap lower, now we're looking down into the 2080s, even down to 2083 as well. Then, this is part of the reason why I switched some of the indicators over, even though our oscillators had already been negative. The PMO, the MACD, the KST, and there's some even other ones that I'm going to start introducing over a period of time that I've been looking at every day, but I want to take some time to actually explain them. And in some ways you could say they're variations on the same thing, but some of them are calculated a little bit differently, some of them behave a little bit differently, and so I like to look at them. But it's just safe to assume that all of them are trending down right now. But price, and this is why I probably could have changed the short-term moving average trend even down, but I want to see how tomorrow plays out first before I change that. I changed the oscillators today, which if we have a monster up day tomorrow, they're going to go back to mixed. See, this is the most weird time when you're analyzing the market, is it's when we're at a top. Now at a bottom it's a little easier to figure out because you see more climactic selling, and it's more of what you call I'm trying to come up with it, a mass reading, when capitulation and just everything kind of converging all at once. Tops can be more rounded, like we're seeing, where people aren't as freaked out because we're near the top, and most people are geared in their portfolios for the market to go up, not realizing that you can make a ton of money with the market going down and when they're going sideways. Most people don't know that. So it's usually when we're going down, market bottoms are easier to figure out than market tops a lot of times. At least in my experience, that's been the case. So we still have a lot of people out there that are very bullish on things. And if you remember back just a couple of weeks ago, I was taking some real issue with people that I really respect, that are technical analysis folks that I learned a lot from. And it's like they're not even looking at their own charts. Don't you see the stuff that you told me, that you taught me about? And yet they're just saying this market wants to go up, man. It's just, yeah, through the roof. Yeah, man, everything's looking great. And I'm like, wait a minute, read your own books, read your own articles, look at your own software. It's telling you no, it's screaming. We could be in some real trouble here. Now, we won't know that for sure until after the fact, but we can kind of see things as they're playing out right now. And the long-term warning signs that I've been talking about may be starting to come into play. Now, that could be all erased if we have an up day tomorrow, or it could be more of a confirmation if we have a down day tomorrow. So we just this is where we have to take it one day at a time. This is why watching the videos every day is imperative, not just once a week or so, once or twice a week. Now, some of you weekly folks who are not even hearing this right now because you belong to the weekly plan, you don't have a choice, and you're much longer term in your focus. But if you're more short to intermediate term, you need to be watching these videos every single day, because there are things that I'm assuming that you're understanding that I mentioned in last night's video and the video the night before. I'm just assuming that you listened to it, and so I'm just going to plow right ahead and be aware that I'm going to do more of that as I record more videos, because these videos are pretty long right now. My goodness, the other night was 48 minutes. Who has 48 minutes in their day? That's almost an hour. An hour out of your busy day already to watch a video. Well, if I can stop teaching as much in the videos and seeing that folks are watching them every single day, then yeah, I'll be able to shorten the videos. But I have to lengthen them out because I get questions from folks. It's like, I explained this in last night's video. Well, I didn't get a chance to watch it. Well, so then I have to explain it tonight again. So that's one of the reasons why the videos are a little longer. Not just because I love to talk, which I seem to be able to have a gift for that, but anyway. So we broke down below the 50 period moving average, and so this notation is actually not quite correct. I should have changed that. This is just an updated version of this chart without the text being changed. So I'm kind of under a time constraint on Thursdays, most Thursdays. So I teach late and I have to be at church early. So there's only a real small window of time when I can record this, and so I have a tendency to miss some things at times. But here we're seeing our bullish percent index. That's kind of a positive. Even though it was down today, it didn't really gyrate down. We didn't see a real big reading out of this. So even though it's been diverging longer term, it didn't show a real significant down drop. Now, if we continue to fall, expect the bullish percent index to pick up steam to the downside as well. That's what we're looking for in confirmation. If that doesn't happen, then that's a positive sign that things might be turning around to the upside. But so we're going to be keeping an eye on that one too. We're in our trading range. You can see that we're down, getting more into the middle part, kind of the upper 2/3 right now of the current trading range. But you can see how we saw an increase in volume today on a down day. And that's the same message that I've been just hammering for months now, that we start to see more intensity to the downside than we do to the upside. And we saw a prime example of that today. Whoops, didn't mean to go that fast. Getting a little trigger happy here. The ADX is starting to pop its head up as we're going down. If we continue to go down, this puppy may just go across 20 and signal that we're back into a trend. So there, you could make a strong case right now that the market is getting set to really break lower. this sell in May and go away because the market tends to go in the toilet. I added that last part myself. Um, it might be coming about. Usually, we have the dog days of summer coming up, and a lot of times the market really drifts, if not declines. So we're seeing some more life out of this ADX as we've been going down. Then the stochastics, which are again kind of crazy anyway, but this is short term. Um, this is suggesting that we're in a downtrend and have been pretty much since that down day that we had the day after Memorial Weekend, that Tuesday, that was pretty significant because we broke through short-term support right here. We broke to the downside. We've been trailing along this pivot level. Well, now we broke through the pivot level for June already. So we're fighting a negative battle right now as far as the charts are concerned. We want to be above this pivot level for the month of June to be positive. We've already broken below it, and here it is the 4th. And it's going to take some work to get back above that. We might, but the charts are suggesting that we still have more room to fall as well. And on the daily chart, S1 is down around 2071, or it's 2072-ish or so. So, and then S2 is down right near the lower end of our trading range. It's at 2038? The lower end of our trading range is 2040. So we could really see some more. There's room. Speaking from a technical analysis standpoint. Now we're not going to go right there necessarily, but there you could make a case that we're going to break, and then the real significant level is going to be back to the lower end of this trading range. I'm not saying that that's what's going to happen, but the chart suggests that that could be what's going to happen. Okay, so we're done with that. Our parabolic SAR, stop and reverse. This is still showing that we're negative, and it was confirmed more today. And again, there are some folks that base a whole trading system just on this indicator. Just like the summation index that I always say is one of my favorite indicators. I used to base a whole RIDEX mutual fund strategy just on the summation index. When it was going up, I was in an enhanced mutual fund. When it was going down, I was in an inverse mutual fund. I used to teach classes on that and do daily videos and the whole bit just on that. Now, with the growth of ETFs, we have a lot more opportunities that are available to us than we had 10 years ago because of the popularity of exchange traded funds and how that they're starting to replace mutual funds. Okay, then I brought up a new indicator that's showing, and this is more short term, but be aware. This is showing that we're oversold right now on a short term basis. Okay, but it's called the Williams percent R. Bet you'll never guess the last name of the guy that invented this. And it's a good indicator. I like it. I've used it for a long time. This is the first time I'm showing it on a video. But my problem with it is we can be buried in overbought or oversold conditions for a long time based on this indicator. And we've just gone into oversold territory right now, which means we've gone down too far too fast. This is a pretty responsive indicator. This is a short-term indicator. So, well, this could stay pegged if we continue more to the downside, which may suggest that we might see a little bit of an upside. But again, look at other times when we came down. There are times when we darted in and darted back out. But there's other times when we stayed in this oversold area for extended periods of time, for more than a few days. So I just wanted to introduce this chart to you, and then we'll see if it's I would have a tendency to say we still have some more downside that could be taken care of. Now that could all change if the market responds positively to Greece and to the employment report tomorrow. But looking at things right now, it looks like we've got more downside potential here. Here's the summation index also going down, and has been going down for a while now. We have another down day or two ahead of us, and this thing is actually going to drop below zero. I don't really pay attention to this line so much. Some people do. I don't. I'm looking at the trend of the line altogether, because this is, and you can see for most, especially in April, where we've been pretty sideways and we've been getting whipsawed all over the place. It's been in a pretty comfortable downtrend for quite some time now. And sometimes this indicator is a leading indicator. If you go back to 2000, this thing was flashing warning signs months before we hit a top in the market in the summer of 2000. So that's why I really like to watch this indicator and I look at it every day, and it'll be in every video that I do. Then here's bonds had a bit of an up day after having 3 just horrendous down days. They actually recovered a little bit today. This is the Vanguard ETF, which takes all the different bonds and packages them up as an exchange traded fund, and then you can buy it and sell it like you do a stock. So you don't have to go into the bond market and actually buy something. This allows you to play the bond market through the stock market, through a brokerage account. So I just wanted to show, I don't have any of the yield charts up today because they didn't really do too much. I just wanted to show you that we did see a bit of a recovery in bonds. And then this is the chart I wanted to bring up yesterday but was not able to. The German 10-year Bund, B-U-N-D, how interest rates have just been, since April 20th or so, have just been skyrocketing. They were under 10% or 1%. And now we're up to 0.84%. Okay, so we're getting up to the 1% level in their 10-year right now. What did I say? 1%, 10%, 1%. Okay. We were down below 0.1 right here. Now we're up to 0.84. And yesterday's chart got all screwed up. They had some erroneous data on here that really it made the chart look all weird, and I didn't even put it on the video last night. But we're keeping an eye on this because the German bond market tends to be the real benchmark over there. So we want to keep an eye on that. We keep an eye on the FTSE, which is the London version of the Dow, and then also I'm keeping an eye on Greece, and am I looking at Russia today? Here's Greece. Again, not that anything has happened much over there. They were down 1.3% today, but they've been going sideways as this whole situation plays out. But they were, you've lost a ton of money if you went long the Greece market for a couple years ago. You've had your shirt handed to you a couple of times in that market, and so they're having some real trouble. Then okay, I did bring this up. The Russian market, the different ETFs that I follow, there's something, Russia's not doing too well right now as far as their stock market is concerned. This ETF was down 4.5%. This ETF was down over 4%. And this ETF was down 0.81%. So they're having some trouble over there right now. Not really sure what's going on these days in good old Russia, but the stock market isn't really liking what's happening. Then here's some sectors that got hit. All 10 sectors, which again I may convert back to 9, but sometimes what I'll do is if a sector goes up or down more than 1% in a day, I'll generally bring a chart up of that particular sector of the 9 or 10 that we follow in the S&P 500. Energy, which has been showing some real weakness, got hit hard again today. It was down 1.24% right now. Very heavily traded ETF right here. You could do a lot of stuff with this, as well as the industrials. Even though they've been more in a sideways pattern, they did get hit over 1% today, but we're still more in a trading range on the industrial stocks that make up the S&P 500. This would be something you do more, I think, on the sector chart that I'll bring up at the end. You'd be doing more sideways strategies with this type of, I think it's up slightly, but you'd be doing covered call writing and butterfly spreads and iron condors and all kinds of exotic sounding things that benefit when the market goes sideways or when this particular sector goes sideways. Then materials got hit pretty hard today and actually broke through some support. I don't really annotate these charts all that much. As I get time, I may start putting some lines on here other than the pivot points. But they got hit pretty hard, over 1% today as well. Then here's the sectors, and the industrials, yeah, see they're down less than 1%. So you would have been doing covered call type strategies, butterfly spreads, which I teach about in our classes, iron condors, calendar spreads even, and so forth, that can benefit when these sectors, like the industrials and, well, energy, that should be down a little more than it is. But overall, it's been been getting hit pretty hard lately. And then the utilities, which have really been getting hit this year so far. This is going back to this is year to date, where healthcare had a little bit of a decline today, but it's the strongest sector in the S&P 500 so far this year. Okay, so there really wasn't anything as significant today that came out economically. We had the weekly jobless claims came in a little weaker than expected. That's why it's in red. Continuing claims also came in a little lower than expected. And then productivity and unit labor costs the unit labor costs came in less than expected, where let me start that over. The productivity, which is a revised number, that's what the REV stands for. It came in weaker than expected. It originally thought they were going to be up minus 2.9%. They were actually down more than that at 3.1%. And then costs. So people are becoming less productive, but they're costing more to be less productive. So this is kind of negative overall. They expected the labor costs to be up 5.9%. They were actually up 6.7%. But these aren't real major players in the market. Tomorrow's the biggie. We get non-farm payrolls expecting 225,000. The unemployment number, that's the one that gets a headline, but it's considered almost irrelevant to the markets because there's so much manipulation that's done to that number now. It doesn't really give a true reading of what's going on. But then the market also really pays attention to the hourly earnings. They're expecting that to increase 0.2%, and the average hourly work week, they're expecting to be up to 34.5. Remember, 40 hours would be a full-time job. We never really hit 40 hours on this reading because there's so many part-time jobs out there, and a lot of people that work 2 part-time jobs. That doesn't count as 1 full-time job. And then at 11 o'clock our time, consumer credit comes out, but that probably they're expecting just a mere 17 billion of consumer credit increase for this month. Isn't that amazing? But the big ones come out at 5:30 tomorrow morning Pacific time. So what I've done, I probably could have made a case, but I'm waiting until tomorrow to see what happens. The moving averages, if we close below that 50-period moving average on Friday, I'm going to change this to down. The short term, it's going to be from an up to a down. I probably could have changed it to mix, but I forgot. Okay. Intermediate term and long term, the 50 period and the 200 period moving, I'm sorry. Yeah, okay. This is the intermediate term is more the 200 period moving average. When it goes long term is when the lines actually cross over, and we're far from that happening right now. But our oscillators are pretty much looking down in all 3 time frames right now. So overall, you could probably conclude we're mixed because we're still range bound until we deal with this 2135 to the upside or 2040 to the downside area that we've been in all year long so far. Okay, so that concludes the update for Thursday evening, and the next video that I prepare should be posted over the weekend. So have a great Friday, and we'll talk to you Saturday or Sunday.